The market today is telling us one thing with absolute clarity: the era of unconditional technology dominance is entering its first phase of genuine uncertainty. Let me paint the global picture for you. We're witnessing a coordinated rotation of capital that speaks to something deeper than daily trading noise. The Fear and Greed Index sits at 41, firmly in fear territory, but this isn't panic fear. This is calculated institutional fear, the kind that moves billions of dollars with surgical precision. Major indices closed mixed, but that headline obscures the real story unfolding beneath the surface. This is a market in the early stages of repricing risk across entire sectors. Now, let's decode the stock signals that matter. First, technology's stumble today wasn't about earnings or guidance. Look at the pattern. Semiconductor stocks led the decline, with several major chip manufacturers dropping between 2–4% in coordinated selling. This came precisely as reports emerged of China accelerating domestic chip production capabilities and the European Union announcing a €50 billion semiconductor sovereignty initiative. The market is beginning to price in the end of American chip hegemony. What we're witnessing is the first tremor of a tectonic shift that will reshape technology valuations over the next decade. Second, the energy sector's 3.2% surge tells a geopolitical story. This wasn't driven by oil price movements alone, it was driven by the market pricing in long-term supply disruption risks. With ongoing tensions in Eastern Europe and Middle Eastern supply routes facing persistent uncertainty, institutional money is positioning for an energy scarcity premium that could persist for years. The sophisticated money sees energy not as a commodity play, but as a geopolitical hedge. Third, the financial sector's mixed performance reveals a banking system caught between two opposing forces: rising interest rate expectations that boost lending margins versus credit quality concerns that threaten loan portfolios. Regional banks fell while major money centers held steady. This divergence signals institutional awareness that size and diversification will determine survival in the next credit cycle. Now, let's examine the crypto layer, because digital assets are providing real-time intelligence about trust in traditional systems. Bitcoin surged 4.7% today, breaking through key resistance at $45,000, but this wasn't speculative buying. On-chain analysis reveals institutional wallet activity increased 34% in the past 48 hours. This is sophisticated money using Bitcoin exactly as digital gold, a hedge against currency debasement and geopolitical instability. Ethereum's 6.2% gain came alongside record activity on decentralized finance protocols, signaling institutional adoption of blockchain-based financial infrastructure. Here's what crypto is telling us that equities cannot. There's a growing institutional belief that traditional monetary policy has reached its limits. When central banks globally are trapped between inflation concerns and growth imperatives, sophisticated investors are allocating to assets outside traditional monetary control. Crypto's surge today directly contradicts the stock market's risk-off sentiment. This divergence signals that institutional investors are distinguishing between traditional risk assets and alternative monetary systems. The crypto market's behavior is confirming what bond markets have been whispering: confidence in central bank omnipotence is waning. When crypto rises as stocks fall, it signals investors seeking alternatives to both growth assets and traditional safe havens. Now, let's apply the geopolitical lens, because this is where financial intelligence separates from financial entertainment. Today's market movements are directly connected to three geopolitical developments most financial media is missing. First, the European Central Bank's unexpected hawkish commentary came not from inflation concerns, but from growing awareness that energy dependence has become a monetary policy constraint. European officials are pricing in semi-permanent energy cost inflation that requires preemptive monetary tightening. Second, gold's 2.1% surge to $2,031 per ounce occurred precisely as reports emerged of central banks in Asia and the Middle East accelerating bullion purchases. This isn't inflation hedging, this is monetary sovereignty positioning. Countries are preparing for a multipolar monetary system where dollar dominance cannot be assumed. Third, agricultural commodity futures surged across the board as Ukrainian grain export agreements face renewed uncertainty. Wheat up 3.4%, corn up 2.8%. This matters because food inflation is the most politically destabilizing form of price pressure. Governments worldwide are beginning to stockpile agricultural commodities as geopolitical insurance, creating artificial scarcity in global food markets. The intelligence edge that connects everything. We are witnessing the early stages of economic deglobalization masquerading as market volatility. Today's seemingly random market movements, tech falling, energy rising, crypto surging, gold climbing, are actually coordinated responses to a single underlying reality. The integrated global economy of the past 3 decades is fragmenting into competing blocks, and capital is repositioning accordingly. The technology sector is falling because investors recognize that tech supremacy requires supply chain control, and supply chains are being weaponized. Energy is rising because secure energy access is becoming more valuable than efficient energy markets. Crypto is surging because monetary sovereignty is fracturing along geopolitical lines. Gold is climbing because the universal reserve asset is becoming more valuable as universal trust declines. Institutional investors aren't just rotating between sectors, they are rotating between economic paradigms. The assumption that efficiency and integration would always triumph over security and sovereignty is being challenged by geopolitical reality. What should an intelligent citizen understand? The financial system is not experiencing temporary volatility, it's adapting to a permanently more fragmented world. Investment strategies that worked in an era of global integration may not work in an era of strategic competition. The market is telling us that the next decade will reward ownership of scarce, essential, and domestically controlled assets over scalable, efficient, and globally integrated ones. This shift will create winners and losers not just among companies but among entire economic philosophies. Here's the question that should keep you thinking tonight. If markets are pricing in economic deglobalization, what does that mean for a generation that has only known economic integration? If this intelligence served you today, comment. The signal is clear below. Subscribe and I will see you tomorrow with the next briefing.